There is a single question that separates the amateur from the master, the gambler from the investor, the 99% who churn their accounts into dust from the 1% who build generational fortunes. It is not a question about price-to-earnings ratios or discounted cash flow models or the next hot technology. It is a question directed not at the market but at the reflection in the mirror. The question is this: how could I be wrong? It is the simplest inquiry in the world, and yet it is the most powerful tool for risk management and long-term wealth creation ever devised. In the world of finance, we are taught to build a case, to assemble the facts that support our brilliant idea, to construct an argument so compelling that we have no choice but to act. But this is the path to ruin. Warren Buffett, the most successful investor in human history, built his empire on the opposite principle. His goal, his method, his secret weapon, is to try and kill his own best ideas. He doesn't seek confirmation, he hunts for disconfirming evidence. He doesn't look for reasons to buy, he looks for every possible reason not to. This is the final promise of rational investing: to build a process so robust that it saves you from your own worst enemy, yourself. Today, we are not just learning a new investment strategy, we are installing a new operating system for your mind. A system designed to make you your own most ruthless critic, to stress test your ideas against reality, and to construct a portfolio that is not just successful but anti-fragile. We will deconstruct this CEO mindset into 5 distinct pillars, and by the end of our journey, you will possess a mental framework that will permanently alter your relationship with money, with risk, and with the very process of decision-making. Our first pillar is the foundational mental shift, the turning of the map upside down. It is the principle of intellectual inversion, the art of becoming your own devil's advocate. To truly understand its power, we must first examine what happens when even the greatest mind in investing neglects it. We have to travel back to 1993, a time when Warren Buffett was seen as infallible, a financial deity walking among mortals. Berkshire Hathaway was a juggernaut, and every decision Buffett made seemed to turn to gold. It was in this environment that he encountered a business that seemed to tick every single one of his boxes. The company was the Dexter Shoe Company, based in the small town of Dexter, Maine. It was a classic Buffett-style business. It had a long history, founded in 1957. It had a strong brand, known for durable, American-made shoes and boots. It was consistently profitable, a cash-generating machine that required little capital expenditure. And most importantly, it seemed to possess what Buffett calls a durable competitive advantage, or a moat. For decades, Dexter had dominated its niche. It felt permanent. Buffett was so confident in this assessment that he did something he rarely did before and has rarely done since. He paid for the entire company not with cash, but with Berkshire Hathaway stock. The price was $433 million, which equated to 203 shares of Berkshire Class A stock. At the time, this seemed like a stroke of genius. He was using his own highly valued currency to acquire a wonderful, cash-producing asset without spending a dime of Berkshire's capital. He later wrote to his shareholders, "I've passed on a lot of deals that were in our size range, but Dexter is one that I'd have been delighted to do in far greater size." He was in love with the idea. He saw decades of steady, reliable earnings stretching out before him, but he had made a fatal error in his analysis. He had failed to properly invert the question. He had asked, "What makes this a great business?" And the answers were plentiful. He had not asked with sufficient rigor, "What could destroy this business?" If he had, he would have discovered a single, terrifying piece of disconfirming evidence. Dexter Shoe's competitive moat was not based on a brand or a proprietary process. It was based on the simple fact that it was an American manufacturer. Its cost structure was competitive relative to other domestic producers. What Buffett failed to appreciate was the tectonic shift happening in the global economy. Trade barriers were falling, and low-cost manufacturing from overseas was becoming a tidal wave. Suddenly, companies could produce shoes of similar quality in countries with dramatically lower labor costs. Dexter's moat, which looked like a solid stone castle, was actually made of sand, and the tide was coming in. Within a few short years, the company's competitive advantage was completely gone. Profits evaporated. Dexter became a financial black hole, a zombie asset inside the Berkshire portfolio. But the true cost wasn't the $433 million purchase price. The true cost was the Berkshire Hathaway stock he had used to pay for it. Those 203 shares, had they remained in Berkshire's treasury, would today be worth not millions but tens of billions of dollars. In his 2007 letter to shareholders, Buffett himself called the Dexter deal the worst he had ever made, a permanent capital loss of staggering proportions. He wrote, and I quote, "I gave away 1.6% of a wonderful business, one that would become far more wonderful, to buy a business that was destined to disappear." He concluded with a sentence that is the very soul of this principle. What I had assessed as a durable competitive advantage vanished within a few years. He had fallen for his own story and paid the ultimate price. This multi-billion-dollar mistake serves as the foundational anecdote for our exploration, a stark and permanent reminder that no matter how intelligent you are, if you fail to actively hunt for the evidence that proves you wrong, the market will eventually do it for you, and it will show no mercy. The reason a mind as brilliant as Buffett's could make such a colossal error is not a failure of intelligence, but a failure to overcome a fundamental feature of human psychology. We are all, by default, wired to do the exact opposite of what is required for successful long-term investing. The underlying psychological principle at play here is our brain's deep-seated preference for mental shortcuts. One of the most powerful and dangerous of these is what we call narrative coherence. Our brains are story processing machines. We crave simple, clear narratives that explain the world. When Buffett looked at Dexter Shoe, his brain constructed a beautiful story. An honest American company with a long history of profitability and a strong brand will continue to be profitable. It's a clean, simple, and satisfying story. The problem is that reality is messy, complex, and often counterintuitive. The human brain abhors a vacuum, and it despises complexity. It will therefore seize upon the simplest narrative, and then engage in a relentless campaign to prove that narrative is true. This is the root of confirmation bias, but the impulse is deeper. It's about maintaining a stable, coherent view of the world. Admitting you are wrong about an investment thesis is not just a financial loss. It is a psychological blow. It means your story about the world was incorrect. It disrupts your sense of coherence. Therefore, your brain's default setting is to protect the story at all costs. This is where the mental model of inversion, famously championed by Buffett's partner Charlie Munger, becomes a cognitive superpower. Munger borrowed the concept from the 19th century German mathematician Carl Jacobi, who believed that the best way to solve difficult problems was often to approach them backward. Jacobi's mantra was simple: invert, always invert. In the context of decision-making, this means that instead of asking how can I achieve a good outcome, you must first ask what are all the things that could cause a bad outcome. Instead of focusing on the path to success, you obsessively map out every single path to failure. This seemingly simple flip in perspective is profoundly effective because it short-circuits the brain's narrative-seeking and confirmation-seeking machinery. When you ask, how can this investment succeed, your brain immediately starts cherry-picking data that fits a positive story. You'll focus on rising earnings, a new product launch, a positive analyst report. But when you ask, how could this investment go to zero, you force your brain to engage a different cognitive pathway. You are now actively hunting for threats, for weaknesses, for the disconfirming evidence your mind would otherwise filter out. You start looking at the competitor who is gaining market share, the rising input costs that could crush margins, the new technology that could make the company's product obsolete, the fine print in the annual report that mentions a looming lawsuit. You are forcing yourself to confront the messy, complex reality instead of retreating into a clean, simple story. This is the essence of building a CEO mindset. It's about moving from being a cheerleader for your ideas to being a judge, a jury, and an executioner for them. So how do we translate this powerful psychological principle into a practical, repeatable process? How do we build an applied mental model for inversion that we can use every single time we consider a new investment, ensuring we don't repeat Buffett's Dexter shoe mistake? This is the blueprint for becoming your own devil's advocate. It consists of 5 distinct steps. Step 1. Articulate the core thesis. Before you do anything else, you must be able to state in a single, clear sentence why you believe this is a good investment. For example, I am buying stock in Company X because its dominant brand allows it to charge premium prices, leading to high and sustainable profit margins. This sentence is your starting point. It is the idea you are now committed to destroying. Step 2. Frame the inversion. Take your core thesis and flip it into a catastrophic question. The question should be structured like this. What would have to be true for this investment to lose 50% or more of its value and never recover? This framing is crucial. It's not about a temporary dip. It's about permanent capital impairment. This forces you to think about existential threats, not just short-term volatility. For our example, the inverted question becomes, what could permanently destroy Company X's brand and pricing power? Step 3. The kill list brainstorm. Set a timer for 25 minutes and, without any judgment or filtering, list every single possible answer to your inverted question. Think like a saboteur. Think like the company's most vicious competitor. What could kill it? A major product recall? A shift in consumer tastes towards cheaper alternatives? A new technology that renders their product category irrelevant? A scandal involving the CEO that tarnishes the brand? Aggressive price cutting from a new, low-cost competitor? A change in government regulations? Write down everything, no matter how outlandish it seems at first. Your goal is to generate a raw list of potential failure points. This is your kill list. Step 4. The disconfirmation hunt. For the next 7 days, your only job related to this investment is to seek out information that supports the items on your kill list. You are forbidden from reading bullish analyst reports, forbidden from visiting enthusiastic fan forums, and forbidden from rereading the company's glossy investor presentation. Your information diet must consist solely of bearish arguments. Find the most pessimistic analysts and read their reports. Search for news articles about the company's failures and lawsuits. Read the annual reports of their biggest competitors, paying close attention to how they plan to steal market share. Your mission is to find evidence that your initial thesis is wrong. Step 5. The pre-mortem verdict. At the end of the 7 days, you will sit down and write a 1-page pre-mortem. This is a document written from the perspective of an investor 5 years in the future, explaining exactly why the investment in Company X was a disaster. It should begin with the sentence, "The investment in Company X failed, and it was obvious in hindsight. The primary cause of the failure was." Then, using the evidence you gathered during your disconfirmation hunt, you write the story of the company's demise. Only after you have completed this process, only after you have stared into the abyss of failure and made the strongest possible case against your own idea, are you allowed to make an investment decision. If, after all this, your original thesis still holds up, you can invest with a level of confidence and a depth of understanding that few investors ever achieve. You will have earned the right to have an opinion. To fully appreciate the power of this blueprint, we must examine its opposite. We must walk the path of the 99%, the path that leads to financial ruin. This is the antithesis of inversion, and it is the default mode for the majority of retail investors. It begins not with a thesis, but with a tip or a story. Someone hears about a hot stock from a friend, sees it hyped on social media, or reads a breathless article about a revolutionary new technology. There is no rigorous, independent thought. There is only emotional contagion. The investor doesn't articulate a thesis to be tested. They adopt a narrative to be believed. Their first action is not to seek disconfirming evidence, but to dive headfirst into the warmest, most comfortable echo chamber they can find. They join a subreddit dedicated to the stock, where every post is a wildly optimistic projection of future riches. They follow social media accounts that exclusively share positive news and dismiss all skepticism as FUD, fear, uncertainty, and doubt. They fall in love not with the business but with the ticker symbol and the community of fellow believers. Every small increase in the stock price is taken as proof of their genius. Every dip is framed as a healthy consolidation or a buying opportunity orchestrated by evil short sellers. They are no longer investors. They are cult members. Their identity becomes intertwined with the stock's success. Any criticism of the company feels like a personal attack. They are suffering from the most extreme form of confirmation bias, what is known as the endowment effect, where they value something they own far more than its objective worth, simply because they own it. When negative news does break, a bad earnings report, a new competitor, a regulatory challenge, their mind doesn't process it as a potential reason to sell. Instead, it engages in mental gymnastics to explain it away. The CEO is a visionary who is misunderstood. The market is just too stupid to see the long-term potential. This is all part of the plan. They will hold on, defending their position with increasing fervor as the losses mount. They might even don't good money after bad in a desperate attempt to vindicate their initial decision. This is the path that leads to holding a stock all the way from $50 to $5 to 50 cents, all while telling yourself that the big turnaround is just around the corner. The path of the 99% is paved with good intentions and comforting stories, and it leads directly off a financial cliff. It is the antithesis of the rational, detached, and skeptical mindset required for successful long-term investing and achieving true financial freedom. The consequences of these two opposing paths are not merely psychological. They have a direct and dramatic financial connection that manifests on your brokerage statement and determines your net worth. The act of inversion is, at its core, a form of advanced risk management. Its primary financial benefit is the preservation of capital. Warren Buffett has two rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is not a clever quip. It is the mathematical foundation of wealth creation. If you have a portfolio of $100,000 and you suffer a 50% loss, you are left with $50,000. To get back to your starting point, you don't need a 50% gain. You need a 100% gain. The mathematics of loss are brutal and unforgiving. By forcing yourself to focus on the downside, by asking how can this go to zero, you are systematically weeding out the investments that have a high probability of catastrophic failure. This dramatically reduces the likelihood of suffering the kind of large, permanent losses that cripple a portfolio for years. The financial result is a much smoother and more reliable path to portfolio growth. While the story stock chaser experiences wild swings, a massive win followed by a devastating loss, the inverting investor experiences steady, compounding growth. Their asset allocation is inherently more conservative and robust because every position has been rigorously stress-tested against failure. Furthermore, this process has a direct impact on your ability to generate long-term capital gains. By identifying and avoiding the landmines, you are left with a concentrated portfolio of genuinely high-quality businesses that you understand at a profoundly deep level. Because you have already made the case against them and found it wanting, you will have the psychological fortitude to hold them through periods of market volatility. When the market panics and the stock you own drops 20% on a piece of bad news, you won't panic and sell. You will be able to calmly revisit your kill list, assess if the new information represents a genuine threat to your long-term thesis, and act rationally. More often than not, you'll find that the market is overreacting, and you will have the confidence to hold or even buy more. This is how real wealth is built. Not by jumping from one hot stock to the next, but by identifying wonderful businesses and holding them for years, letting the power of compounding work its magic. The inversion process doesn't just help you pick better stocks, it transforms you into the kind of investor who can actually profit from them over the long term. It is the fundamental building block of a professional wealth management strategy, a strategy that prioritizes the certainty of keeping what you have over the speculative possibility of a quick gain. It is the difference between a balance sheet built on a foundation of rock and one built on the shifting sands of hope and hype. Now, we must go deeper. Understanding the need to fight your own biases is the first step, but to truly win this war, you must understand the enemy. Our second pillar is a detailed exploration of the beast itself, the anatomy of confirmation bias. This isn't just a minor quirk in our thinking. It is the single most powerful and destructive force in the world of investing. It is the enemy within, a cognitive ghost in our machine that silently and systematically leads us toward financial self-destruction. To witness its power in a real-world, high-stakes scenario, we need to turn to one of Buffett's greatest triumphs, an investment that on the surface looks like a simple case of buying a great company, but was in reality a masterclass in battling the overwhelming psychological pressure of a negative consensus. We are going back to the mid-1970s, a period of deep economic malaise in the United States. The country was mired in stagflation, a toxic cocktail of high inflation and stagnant economic growth. The stock market was in a brutal bear market, and pessimism was rampant. It was in this environment that Buffett turned his attention to the Washington Post Company. To the average observer in 1973, the Washington Post looked like a terrible investment. The company had just gone public, and its stock price had been immediately cut in half. The entire newspaper industry was facing headwinds. But more importantly, the company was at the center of a political firestorm of unprecedented scale. Its two young reporters, Bob Woodward and Carl Bernstein, were aggressively pursuing a story about a break-in at the Watergate Hotel, a story that was leading directly to the White House and President Richard Nixon. The Nixon administration was openly hostile to the newspaper, with the Attorney General publicly threatening the broadcasting licenses of the television stations owned by the Washington Post Company. These licenses were the company's most profitable assets. The political risk was enormous and palpable. The dominant narrative, the story everyone was telling, was that the Washington Post was a company with a target on its back, taking on the most powerful man in the world, and that it was a foolish and dangerous gamble. The herd was stampeding in one direction, away from this stock. This is where the anatomy of confirmation bias becomes so critical. The average investor, upon seeing this situation, would have their pre-existing pessimistic view of the market confirmed. See, they would think, everything is a mess. The government is unstable, and this company is in the crosshairs. It's too risky. Their brain would seize upon the negative headlines, the political threats, and the falling stock price as overwhelming evidence that their initial gut feeling was correct. They would look for and easily find 1,000 reasons not to invest. But Buffett engaged in a different process. He actively fought against this easy, dominant narrative. He knew that the market's consensus view is often where the biggest mistakes are made. He began a process of seeking objective, disconfirming evidence against the prevailing pessimism. Instead of focusing on the scary headlines, he did the tedious, unglamorous work of analyzing the business itself. He read years of the company's financial reports. He studied the competitive landscape of the newspaper and television markets in Washington, D.C. He assessed the quality and integrity of its management, particularly Katharine Graham. What he discovered through this process of objective inquiry was a set of facts that directly contradicted the popular narrative. He realized that the Washington Post newspaper had a virtual monopoly in its market, creating a deep and durable competitive moat. He saw that its television stations were also dominant players in their local markets and were gushing cash flow. He calculated the intrinsic value of these assets and realized that, at the current stock price, he could buy the entire company for about $80 million. At the same time, he knew that a single one of its television stations alone was likely worth more than that. The market was so fixated on the short-term political drama, the story, that it was offering him the entire enterprise for less than the price of one of its parts. He was actively disconfirming the market's thesis. He was ignoring the noise and focusing on the numbers. He invested over $10 million. a huge sum for Berkshire at the time, and built a large position. He held that stock for decades, and it compounded into a fortune worth well over $1 billion. This was not simply a smart stock pick, it was a psychological triumph. It was a victory over the powerful allure of the prevailing narrative, a demonstration of how the intelligent investor can profit by systematically doubting the consensus and seeking the objective facts that everyone else is too biased or too scared to find. The psychological engine driving the behavior of the investors who sold their Washington Post stock in a panic is one of the most well-documented and insidious features of the human mind. The underlying principle is that our brains are not designed for truth, they are designed for survival. And in an ancestral environment, survival often meant making quick decisions based on incomplete information and sticking with the tribe. Confirmation bias is a direct descendant of this evolutionary pressure. It is not one single bias but a family of related tendencies. The first and most basic is biased search for information. When we have a hypothesis, for example, this is a good stock to buy, our brains don't conduct a neutral, scientific search for evidence. Instead, they selectively search for information that supports the initial hypothesis. We click on the bullish articles, we watch the optimistic interviews with the CEO, and we seek out the opinions of others who agree with us. We are not trying to find the truth, we are trying to feel good about our decision. The second member of this family is biased interpretation of information. Even when we are presented with ambiguous information, we tend to interpret it in a way that confirms our existing beliefs. If a company reports earnings that are good but not great, the bull will interpret this as, quote, solid performance with plenty of room to grow, while the bear will see it as a clear sign of slowing momentum. The data is the same, but the interpretation is filtered through the lens of our pre-existing commitment. The third and most dangerous element is biased memory. We have a tendency to selectively recall information that supports our beliefs, and to forget information that contradicts them. An investor who is in love with a stock will remember all the times the CEO's optimistic predictions came true and conveniently forget all the missed targets and broken promises. This creates a feedback loop of self-deception. Our search for information is biased, our interpretation of it is biased, and our memory of it is biased. The result is that we construct a personal reality, an informational bubble, that is perfectly designed to reinforce our initial gut feeling, regardless of whether that feeling is connected to objective reality. Overcoming this requires not just willpower but a systematic process designed to force exposure to inconvenient truths. It requires an understanding that your brain's default state is to lie to you in the service of comfort and consistency, and that achieving superior returns in the market is impossible until you declare war on this fundamental aspect of your own nature. This is the core challenge of behavioral finance and the key to unlocking a higher level of rational investing. To wage this war effectively, you need more than just awareness. You need a weapon. You need a structured, repeatable mental model that you can deploy to systematically dismantle your own confirmation bias before you commit capital. This blueprint is called the bull, the bear, and the reality. It is a three-part framework designed to force a balanced and intellectually honest assessment of any potential investment. Step 1. Write the bull case. This is the easy part. You must articulate, in writing, the strongest possible argument for why this investment will be a massive success. This should be a detailed document, several pages long if necessary. Detail the company's competitive advantages, its growth prospects, the quality of its management, its valuation, and any catalysts that could send the stock price soaring. You must become the company's most eloquent and persuasive advocate. The goal is to get all of the positive arguments out of your head and onto the page. This step is crucial because it acknowledges and contains your natural optimism. You are giving the bull in your brain a voice, but you are trapping it on the page so it doesn't run wild. Step 2. Write the bear case. This is where the real work begins. You must now adopt the persona of your most intelligent and ruthless enemy. Your task is to write an equally long and detailed rebuttal to your own bull case. You must systematically attack every single point. If you praised the company's brand, you must now detail how that brand is eroding or vulnerable to a shift in consumer trends. If you celebrated its high growth, you must now explain why that growth is unsustainable or based on accounting tricks. If you admired the CEO, you must now dig up every past failure, every questionable decision, every sign of hubris. To do this effectively, you must change your information diet completely. For this step, you are only allowed to consume negative information about the company. Seek out short seller reports, critical articles, and analyses from bearish commentators. Your goal is to construct the most compelling, evidence-based argument for why this company is doomed to fail. This is not about being pessimistic for the sake of it. It is an act of intellectual steel manning, of building the strongest possible version of the argument you disagree with. Step 3. The reality synthesis. You now have two powerful competing documents. You have the dazzling vision of success and the grim tale of failure. Your final step is to act as a neutral judge. You must read both documents and write a one-page synthesis. This document must begin with the following sentence. The most likely outcome for this investment over the next 5 years is. You must then weigh the evidence presented in both cases and arrive at a sober, probabilistic judgment. Acknowledge the key risks from the bear case and assess their likelihood. Acknowledge the key opportunities from the bull case and assess their likelihood. The output should not be a simple buy or sell decision. It should be a nuanced conclusion. For example, the most likely outcome is modest growth, provided that the company can fend off new competition in its primary market. The risk of significant margin compression is high, but the current valuation appears to offer a reasonable margin of safety against this risk. This process forces you to move from the black-and-white thinking of a cheerleader or a doomsayer to the probabilistic thinking of a professional risk manager. It systematically deconstructs your confirmation bias by forcing you to inhabit the mind of your opposition. It is a powerful technique for achieving the objectivity necessary for consistent long-term portfolio growth. The vast majority of market participants follow a path that is the polar opposite of this rigorous three-step process. The path of the 99% is a journey into an informational echo chamber. The typical retail investor begins with a flicker of interest, perhaps from a headline or a YouTube video. This initial exposure is almost always overwhelmingly positive. They then embark on a research process that is nothing more than a quest for confirmation. They Google the company's name, followed by phrases like stock price target or bull case. The search algorithm, designed to give users what they want, dutifully serves up a stream of optimistic articles, analyst upgrades, and puff pieces. They join online communities where dissent is shouted down and skepticism is treated as betrayal. In these digital tribes, a powerful social dynamic takes hold. To be a member in good standing, you must signal your belief in the cause. Posting anything negative is a social taboo. This creates a massive chilling effect on critical thought. The investor is not only battling their own internal confirmation bias, but is also being subjected to intense external social pressure to conform. This process is fueled by what psychologists call social proof, the tendency to assume that the actions of others reflect the correct behavior for a given situation. If thousands of people in an online forum are all saying a stock is going to the moon, the brain of the individual investor interprets this as a strong signal that it must be true. It's an informational cascade, where a few initial opinions are amplified and repeated until they create the illusion of a widespread, well-founded consensus. The investor mistakes this chorus of agreement for a body of evidence. They feel a sense of comfort and belonging. They are part of a team, fighting the good fight against the cynical Wall Street establishment. This emotional and social component makes it nearly impossible for disconfirming evidence to penetrate their bubble. When a reputable analyst publishes a critical report, it's not seen as a data point to be considered. It's seen as an attack from the enemy. It strengthens their resolve rather than challenging their thesis. This is how bubbles are formed and how ordinary, intelligent people get swept up in speculative manias. From the dot-com bubble of the late 90s to the meme stock craze of recent years. The path of the 99% is a psychologically comfortable and socially validating journey that almost invariably ends in financial disaster. It is the complete abandonment of the independent, critical thought that is the hallmark of every successful investor. The direct financial connection between succumbing to confirmation bias and destroying your wealth is undeniable and profound. When an investor operates within an echo chamber, their ability to accurately assess risk is completely compromised. They develop a massive blind spot. They might be an expert on all the reasons the company could succeed, but they are utterly ignorant of the dozen ways it could fail. This leads to a catastrophic misallocation of capital. They might pour a huge percentage of their net worth into a single speculative stock, believing it to be a, quote, sure thing. This is the opposite of a sound asset allocation strategy. Effective wealth management is about diversification and managing risk across a portfolio, not making huge, concentrated bets based on one-sided information. The financial result of this concentration is a portfolio with extreme fragility. It might perform spectacularly for a short period, generating huge paper capital gains. But because it is not built to withstand adversity, a single piece of bad news, an event that a rational, unbiased investor would have identified as a key risk, can wipe out all of those gains and more in a matter of days. Moreover, confirmation bias directly leads to the cardinal sin of investing: buying high and selling low. The echo chamber creates maximum excitement and social proof when the stock price is already high and has been rising for some time. This is when the novice investor, feeling the intense fear of missing out, is most likely to pile in. Then, when the story breaks and the stock price collapses, the same psychological forces work in reverse. The comforting narrative shatters, the online community turns toxic with blame and panic, and the investor, faced with the shocking reality that their thesis was wrong, sells at or near the bottom to stop the financial and emotional pain. They lock in a permanent loss of capital. The investor who systematically battles confirmation bias, using a framework like the bull, the bear, and the reality, experiences the exact opposite financial outcome. Their risk management process leads them to buy when prices are low and pessimism is high, like Buffett with the Washington Post, because that is when the gap between price and intrinsic value is widest. And because they have a deep and balanced understanding of the business, they have the conviction to hold through volatility and sell only when the fundamentals have truly changed or the price has become excessive. This process doesn't just improve your stock picking, it fundamentally rewires your behavior, transforming you from a source of market liquidity for professionals into a rational wealth builder who can achieve genuine financial independence. We have established the necessity of inverting our thinking and the danger of our own internal biases. Now we must get even more practical. How do we operationalize this mindset before we ever risk a single dollar? Our third pillar is a specific, powerful, and actionable technique, the pre-mortem protocol. This is the art of killing your ideas in a controlled environment before the market has a chance to do it for you in a very real and very expensive way. It is one of the most effective strategies for systematically uncovering the disconfirming evidence that your optimistic brain wants to ignore. And to understand its origins in the world of Buffett and Munger, we must go to a pivotal moment in their partnership, the deal that forever changed Buffett's investment philosophy. The story revolves around a box of chocolates. In 1972, Buffett and Munger were presented with an opportunity to buy a company called See's Candies. By all accounts, it was a wonderful business. It had a beloved brand, particularly on the West Coast, a loyal customer base, and it produced fantastic cash flow. But it had one big problem, at least from Buffett's perspective. It was expensive. At this point in his career, Buffett was a devout disciple of his mentor, Benjamin Graham. He was a cigar-butt investor looking for discarded, statistically cheap companies that had one last puff of profit left in them. He bought businesses based almost entirely on their quantitative cheapness, on how much their assets were worth relative to their stock price. See's Candies did not fit this mold. The sellers were asking for $25 million. Buffett calculated that the company's tangible assets, its factories, its inventory, its real estate, were only worth about $8 million. This meant they were asking for a $17 million premium for the intangible assets, the goodwill of the brand. To the cigar butt investor in Buffett, this was heresy. His initial thesis was clear: this is a good business, but it is far too expensive. We should not buy it. He was ready to walk away. This is where Charlie Munger performed what was, in essence, an informal pre-mortem on Buffett's own deeply ingrained investment philosophy. Munger acted as the ultimate devil's advocate against Buffett's core belief system. He forcefully argued that Buffett's framework was dangerously incomplete. He made the case that a truly wonderful business with a durable competitive advantage, like the brand power of See's, was worth a premium price. He was forcing Buffett to seek disconfirming evidence against his own lifelong strategy. Munger's argument was effectively a pre-mortem of their potential decision to pass on the deal. He was saying, let's imagine it's 10 years from now, and we passed on See's. Why was that a terrible mistake? It was a terrible mistake because we were too cheap to buy a phenomenal business that would have compounded our capital at a high rate for decades. We were blinded by our focus on tangible assets and failed to appreciate the immense financial value of a powerful brand. This intellectual battle forced Buffett to confront the weaknesses in his own model. He had to seriously consider the evidence that contradicted his worldview. Munger's bear case against cigar butt investing was that it tethered them to mediocre businesses and prevented them from owning the truly exceptional compounders. In the end, Buffett was convinced. They paid the $25 million. It was a watershed moment. See's Candies went on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, requiring very little additional capital investment. It was an absolute home run. More importantly, it completely rewired Buffett's brain. He later said that See's was the business that taught him the difference between a good business and a wonderful business, and that Munger was the one who set him on that path. The See's Candies deal was a real-time pre-mortem, a structured debate that killed Buffett's old, limited idea about value and allowed a much more powerful, long-term investment strategy to be born. It demonstrates that this protocol isn't just for individual stock ideas. It's for stress testing your most fundamental beliefs about how the market works. The psychological principle that makes the pre-mortem protocol so incredibly effective was identified by the research psychologist Gary Klein. He wanted to understand why traditional brainstorming and risk assessment meetings were so often ineffective. What he discovered was that social dynamics and overconfidence often prevent people from speaking up. When a team is excited about a new project or an investor is excited about a new stock, there is a strong pressure to be optimistic and supportive. Voicing concerns can be seen as being negative, not being a team player, or being overly pessimistic. This social pressure suppresses critical thinking. The pre-mortem cleverly sidesteps this problem by changing the frame of the conversation. Instead of asking what might go wrong, which is a speculative and uncertain question, it asks, this has already failed. What did go wrong? This simple shift in tense from the future to the past has a profound psychological effect. It creates what psychologists call prospective hindsight. By assuming failure has already occurred, it liberates our minds to think more freely and creatively about the potential causes. It removes the social stigma associated with being critical. You are no longer being a pessimist. You are being a historian, explaining a factual event. This framing technique short-circuits our natural optimism bias, the cognitive tendency to be overly optimistic about the outcome of planned actions. We are all prone to the planning fallacy, where we underestimate the time, costs, and risks of future actions, while simultaneously overestimating their benefits. The pre-mortem acts as a direct cognitive antidote to this bias. It forces a realistic, grounded assessment of the potential obstacles and threats that our forward-looking, optimistic brains are likely to ignore. When you say, "the project failed," your brain is licensed to connect the dots in a way it wouldn't otherwise. It can see the chain of events, the subtle warnings that were missed, the cascading consequences of a small initial error. It is a form of structured, disciplined pessimism, and in the world of finance, where the potential for loss is always present, disciplined pessimism is a superpower. It allows you to see the future with greater clarity by imagining its darkest possibilities. So how can you, as an individual investor or entrepreneur, apply this powerful mental model to your own decisions? This is the applied blueprint for conducting a formal pre-mortem protocol on any significant investment or business decision. It is a solitary exercise that requires intellectual honesty and a willingness to be brutal with your own ideas. It consists of 4 distinct phases. Phase 1. The setup. Find a quiet time and place where you will not be disturbed for at least 1 hour. Open a blank document. At the top of the page, write the following prompt. It is, date 1 year from today. Our investment in Company Y, which we made 1 year ago, has been a complete and utter disaster. The stock is down over 50%, and the original investment thesis has been proven definitively wrong. My task is to write the detailed history of this failure, explaining precisely what went wrong and why we should have seen it coming. This setup is non-negotiable. The framing of imagining a future history is the key to unlocking the psychological benefits of the protocol. Phase 2. The failure brainstorm. For the next 30 minutes you must write, in a free-flowing stream of consciousness style, the story of the disaster. Do not censor yourself. Write down every plausible and even some implausible reasons for the failure. Divide your story into categories. Category 1. Internal failures. Did management make a series of terrible capital allocation decisions? Was there a hidden accounting issue that finally came to light? Did the company's culture become toxic, leading to an exodus of key talent? Was the CEO's grand strategic plan a complete flop? Category 2. External failures. Did a new, aggressive competitor come out of nowhere and eat their lunch? Did a technological shift make their product obsolete? Did a change in regulations cripple their business model? Did a recession hit their customers harder than anticipated? Category 3. Thesis failures. This is the most important category. In what ways was your original analysis wrong? Did you overestimate the strength of the company's moat? Did you underestimate the cyclicality of their industry? Were your growth projections wildly optimistic? Did you fail to properly assess the balance sheet risk? You must force yourself to admit where your own thinking was flawed. Phase 3. The triage and fortification. After you have written the complete history of the failure, review it carefully. Your next task is to identify the 2 or 3 most plausible and devastating causes of failure from your story. For each of these key risks, you must now develop a fortification plan. Ask yourself, how can I mitigate this risk? What specific metrics or signposts should I be monitoring to see if this failure scenario is starting to play out? Is there a piece of information I could find now that would help me assess the probability of this risk? For example, if a key risk is a new competitor, your fortification plan might be to set up alerts for their press releases, to read their quarterly reports, and to track their market share data. This phase turns the abstract pessimism of the pre-mortem into a concrete action plan for risk management. Phase 4. The go-no-go decision. Finally, look at your list of key risks and your fortification plans. Ask yourself one last brutal question. Knowing what I know now about all the ways this could fail, am I still willing to make this investment? Does the potential reward justify these specific, identified risks? Sometimes, the pre-mortem will reveal a fatal flaw that you simply cannot mitigate, leading you to abandon the idea. Other times, it will not kill the idea but will make it stronger, allowing you to proceed with a clear-eyed understanding of the dangers and a plan to monitor them. This protocol transforms you from a passive gambler into an active risk manager. The antithesis of the pre-mortem protocol is what we can call the post-mortem rationalization, and it is the standard operating procedure for the 99% of investors who lose money. The journey begins with an investment made on the basis of hope, hype, and a shallow understanding of the business. The investor, high on optimism bias and confirmation bias, sees only the upside. They don't conduct a pre-mortem, they engage in a, quote, pre-celebration, fantasizing about the riches they will acquire when the stock inevitably goes up. They see no risks, only opportunities. Inevitably, reality intervenes. the investment turns sour. The stock price plummets. It is only now, after the financial damage has been done, that the investor is forced to confront the failure. But their psychological defense mechanisms kick in to protect their ego. Instead of conducting an honest and painful analysis of their own flawed decision-making process, they engage in a campaign of post-mortem rationalization. They will blame external factors beyond their control. It was the Fed's fault for raising interest rates. It was the fault of manipulative short sellers who spread lies about the company. It was a black swan event that nobody could have possibly foreseen. The narrative is always one of an innocent victim struck by unforeseeable misfortune. They will conveniently forget the warning signs they ignored, the bearish reports they dismissed, and the nagging doubts they suppressed. They will reframe the loss not as a mistake, but as bad luck. This is incredibly damaging because it prevents any learning from taking place. If the failure was due to bad luck, then there is no need to change your process. You can simply roll the dice again on the next hot stock and hope for better luck next time. This creates a cycle of repeated failure. The investor makes the same mistakes over and over again, each time rationalizing the loss away and learning nothing. The pre-mortem is an act of proactive intellectual humility, designed to prevent mistakes. The post-mortem rationalization is an act of retroactive ego protection, designed to justify mistakes. One leads to a robust investment process and long-term financial independence. The other leads to a depleted brokerage account and a long list of excuses. The direct financial connection of the pre-mortem protocol is stark and immediate. Its primary function is to improve the quality of your capital allocation decisions. Every dollar you have to invest is precious. A dollar allocated to a bad idea is not just a dollar lost, it is a dollar that cannot be allocated to a great idea. By systematically killing your bad ideas before they consume your capital, the pre-mortem protocol dramatically increases the average quality of the assets in your portfolio. Your capital is directed only toward those ideas that have survived a trial by fire, a rigorous and hostile interrogation. This leads to a portfolio with a much higher probability of delivering strong, long-term returns. The financial impact is not just about avoiding losses. It's about maximizing the efficiency of your invested capital. Furthermore, conducting a pre-mortem has a powerful effect on your position sizing and overall risk management. When you have gone through the process of vividly imagining a 50% loss and detailing all the ways it could happen, you become much more prudent about how much capital you are willing to risk on that single idea. The investor who sees only upside might be tempted to make a huge, concentrated bet. But the investor who has just written the detailed obituary of their own investment will be far more likely to take a smaller, more sensible position. This leads to a more balanced and diversified portfolio, one that is not dependent on the success of any single idea. It smooths out returns and protects your overall net worth from the kind of catastrophic single-stock blow-ups that can set your financial freedom goals back by a decade. The pre-mortem protocol is not just a theoretical exercise. It is a practical tool that directly translates into more intelligent asset allocation, better portfolio construction, and a more resilient financial future. It builds the kind of disciplined, CEO mindset that is essential for navigating the inherent uncertainties of the market. We now understand the need for inversion, the nature of our biases, and a specific protocol to combat them before we invest. But the battle doesn't end once the buy order is executed. To maintain objectivity over the long term, we must fundamentally re-engineer the information we consume every single day. Our fourth pillar is about building an antithetical information diet, constructing a personal architecture of objectivity. This is about moving from a passive consumer of information to an active strategic architect of your own knowledge base. To see this principle in its highest form, we need only look at the central pillar of Warren Buffett's entire life, his voracious and highly specific reading habits. It is famously said that Buffett spends up to 80% of his day reading. But what is often overlooked is not the quantity of his reading, but the quality and, most importantly, the structure of it. He is not passively consuming whatever news is put in front of him. He is on a mission, and his reading list is his primary weapon. A perfect illustration of this is his deep research into Coca-Cola before he made his historic billion-dollar investment in 1988. At the time, Coke was already a massive, well-known company. It would have been easy for an investor to rely on the common knowledge, the popular narrative. Coke is a great brand, people drink it all over the world, it's a safe investment. This is the kind of shallow thinking that Buffett despises. Instead, he embarked on a deep, multifaceted research project designed to understand the business from every conceivable angle, especially the negative ones. He didn't just read Coca-Cola's annual reports, he read the annual reports of all its major competitors: PepsiCo, Dr. Pepper, 7-Up. He wanted to understand how the competition thought, what their strategies were, and where they saw Coke's vulnerabilities. He was actively seeking out the bear case from the people who had the most incentive to create it. He didn't stop there. He went back and read decades of Coke's historical reports to understand how the business had evolved, what mistakes management had made in the past, and how they had handled previous crises, like the disastrous new Coke launch in 1985. He studied that failure intently, seeing it not as a reason to avoid the stock, but as a powerful piece of evidence confirming the incredible passion consumers had for the original formula, a key component of its moat. He talked to industry consultants, he talked to competitors, he talked to advertising executives. He even, by his own account, had people in the Berkshire office conduct scuttlebutt research, observing what people were drinking in different stores. He was building a complete, 360-degree mosaic of the business. His information diet was intentionally antithetical. He was not just looking for reasons to confirm his initial hunch that Coke was a great business. He was actively searching for the counter-argument. He was trying to understand the world from the perspective of Pepsi's CEO. He was trying to understand the risks, the challenges, the competitive threats with the same depth and clarity as he understood the opportunities. It was only after this exhaustive process, after building a rich, multi-perspective understanding of the entire soft drink industry, that he felt comfortable investing. He wasn't buying a stock ticker. He was buying a piece of a business that he understood as well as, or even better than, the people running it. This is the gold standard of an antithetical information diet, a relentless, proactive search for the complete picture, with a special emphasis on the parts of the picture that you don't want to see. The psychological principle underpinning the need for such a structured diet is known as the, quote, availability heuristic. This is a mental shortcut our brains use to judge the likelihood of an event based on how easily examples of that event come to mind. Things that are recent, frequently repeated, or emotionally charged are perceived as being more common and more important than they actually are. In the world of investing, the financial media is a super stimulus for the availability heuristic. The news cycle is dominated by dramatic stories, the stock that soared 1,000%, the new technology that will change the world, the charismatic CEO with a bold vision. These stories are readily available, they are repeated constantly, and they are emotionally compelling. As a result, our brains dramatically overestimate their importance and their applicability to our own investment decisions. We start to believe that finding the next Amazon is a common and achievable goal, simply because stories about Amazon's success are so readily available. Conversely, the information that is truly important for long-term investing, the slow, boring, and complex details of a company's competitive position, its return on invested capital, its balance sheet strength, is not readily available. It is buried in dense, 100-page regulatory filings. It is not exciting or emotional. Therefore, our brains underweight its importance. A passive information diet, one that is determined by news headlines and social media feeds, will inevitably lead to a warped perception of reality. You will be constantly bombarded with hype and narrative, while remaining blissfully ignorant of the underlying fundamentals. Building an antithetical information diet is a conscious effort to counteract the availability heuristic. It is the act of deliberately elevating the importance of the boring but crucial information and systematically seeking out the negative or contrary information that the media and your own brain would prefer to ignore. It is an acknowledgement that your default information stream is biased and that you must become the active editor-in-chief of your own mind, curating a flow of knowledge that is designed for accuracy, not for entertainment or emotional comfort. This is a core discipline of financial education and a non-negotiable requirement for any serious retail investor. So how do we move from being passive victims of the algorithm to active architects of our own understanding? This is the applied mental model for constructing your antithetical information diet. It is a system with three core components: the core, the counter, and the periphery. Component 1. The core. This is your foundation of deep, primary source material. For every company you own or are seriously considering, you must commit to reading the last 3 years of annual reports, the 10K filings, and the last 4 quarterly reports, the 10Q filings. This is non-negotiable. These are dense legalistic documents, but they are the ground truth of the business. You must also listen to the last 4 quarterly conference calls. This is where management discusses the results and answers questions from analysts. Pay more attention to the analysts' questions than to management's prepared remarks. The questions often reveal the key controversies and concerns of the professional investment community. Your core diet is boring, difficult, and absolutely essential. It must be the largest portion of your information consumption. Component 2. The counter. For every hour you spend consuming core materials from the company itself, you must spend at least 30 minutes consuming contrary or competitive information. This is where you actively seek out the bear case. For each of your companies, you must identify and follow 1 or 2 smart, well-reasoned bears. These might be short sellers, skeptical journalists, or analysts with a sell rating. You are not looking for cranks or conspiracy theorists. You are looking for intelligent people who have a different interpretation of the same set of facts. You must also add the top 2 competitors for each of your companies to your reading list. Commit to reading their annual reports and listening to their conference calls as well. This will give you an invaluable outside-in perspective on your own company's strengths and weaknesses. The goal of the counter is to constantly inoculate yourself against your own bullish narrative. Component 3. The periphery. This involves broadening your reading beyond specific companies to the wider industry and macroeconomic landscape. You should subscribe to at least one high-quality trade journal for each major industry in which you are invested. This will keep you abreast of slow-moving structural changes that might not make the headlines but could have a profound long-term impact on your investments. You should also regularly read publications known for their high-quality, long-form, and often contrarian economic and market analysis. This helps you understand the broader context in which your companies are operating. Your information diet should be structured like a food pyramid. The broad base should be the core primary source documents. The middle layer should be the counter-arguments and competitive analysis. And the small top portion should be the broad peripheral context. This structured approach starves your biases and feeds your intellect. It is the daily discipline that separates the amateur from the professional and is the key to building lasting wealth. The path of the 99% is the exact inversion of this disciplined structure. The average investor's information diet is not a pyramid. It is an inverted pyramid, a dangerously unstable structure built on a foundation of fluff. The vast majority of their research consists of consuming peripheral, low-quality information. This includes sensationalist headlines from free financial news websites, unverified DD, due diligence posts on social media platforms like Reddit and Twitter, and algorithmically recommended YouTube videos that are optimized for clicks and watch time, not for accuracy or depth. This information is the equivalent of intellectual junk food. It is emotionally satisfying and easy to consume, but it has zero nutritional value. It is designed to generate engagement, not to create informed investors. The next layer of their consumption is a distorted form of counter-information. They might be aware of the bears and the short sellers, but they don't engage with their arguments in good faith. Instead, they seek out content that debunks or mocks the bearish view, reinforcing their own position and casting the critics as foolish or malevolent. They are not seeking to understand the counter-argument. They are seeking to defeat it emotionally. Finally, the smallest part of their diet, if it exists at all, is the core material. Most retail investors have never read a 10K filing in their life. They see it as too long, too boring, or too complicated. They outsource their thinking to others, to the social media gurus, the YouTubers, the anonymous forum posters. They are willingly plugging themselves into a matrix of narrative and hype, a carefully constructed reality that is completely detached from the underlying financial and operational realities of the businesses they are investing in. This diet creates an investor who is incredibly confident but breathtakingly ignorant. They can recite the bull case narrative by heart, but they couldn't tell you the company's debt-to-equity ratio or its 5-year trend in profit margins. They are a walking, talking embodiment of the Dunning-Kruger effect, a cognitive bias where people with low ability at a task overestimate their ability. This is the path to ruin, a self-inflicted wound caused by a willful diet of ignorance and confirmation. The direct financial connection between your information diet and your portfolio's health is as clear as the link between a diet of fast food and physical health. An investor who lives on a diet of hype and headlines will have a portfolio that reflects this. It will be volatile, speculative, and prone to dramatic crashes. They will constantly be chasing the latest story, buying at the peak of excitement and selling in the trough of disillusionment. Their portfolio turnover will be high, and their transaction costs and taxes will eat away at any potential returns. Their wealth management strategy is nothing more than a chaotic and reactive scramble from one popular idea to the next. The financial statement of such an investor is a story of churn, losses, and missed opportunities. On the other hand, the investor who meticulously curates a structured, antithetical information diet will build a portfolio with completely different characteristics. It will be stable, resilient, and built for the long term. Because their decisions are based on a deep understanding of business fundamentals, they will be less susceptible to market fads and panics. Their portfolio will be concentrated in high-quality businesses that they understand intimately. This leads directly to superior financial outcomes. Their lower turnover means lower transaction costs and more favorable tax treatment on long-term capital gains. Their ability to hold through market downturns allows them to capture the full benefit of long-term compounding. Their deep knowledge allows them to identify genuine buying opportunities when others are panicking. The balance sheet of this investor shows steady, tax-efficient portfolio growth built on a foundation of knowledge and discipline. Your information diet is the single leading indicator of your future financial success. A low-quality diet will inevitably produce a low-quality portfolio and a low-quality financial life. A high-quality, structured, and antithetical diet is the single most powerful investment you can make in your journey toward financial freedom. It is the engine of rational investing. We have arrived at our final pillar, the one that ties all the others together. It acts as a master filter, a powerful constraint that makes the entire process of seeking disconfirming evidence not just possible, but manageable. This is the concept of the circle of competence, and it is perhaps the most profound and most misunderstood of all of Buffett's ideas. It is the superpower of knowing what you don't know, and the discipline to say no to everything that lies outside that boundary. The most powerful foundational anecdote for this principle is not a single investment Buffett made, but the thousands of investments he pointedly refused to make. We must travel to the late 1990s, the height of the dot-com bubble. It was a time of pure, unadulterated mania. A new paradigm had been declared. The old rules of valuation no longer applied. Companies with no profits, no revenues, and in some cases no finished products were coming to the market and achieving billion-dollar valuations overnight. The stock market was a rocket ship, and anyone not on board was being mocked as a dinosaur, a relic of a bygone era. And the chief dinosaur, in the eyes of the media and the new generation of tech investors, was Warren Buffett. While the Nasdaq Composite Index was soaring by triple digits, Berkshire Hathaway's stock was lagging. Buffett was sitting on the sidelines, watching the party from a distance. He was publicly and relentlessly criticized. Magazine covers declared him, washed up. Pundits claimed his value investing philosophy was dead, a fossil in the new digital age. The pressure on him to join the frenzy was immense. His own shareholders were questioning him. His legacy was on the line. And yet, he did nothing. He refused to buy the hot tech and internet stocks. His reason was disarmingly simple, and he stated it over and over again. I don't understand them. He couldn't predict what the world of technology would look like in 10 or 20 years. He didn't know which of the hundreds of competing dot-coms would survive and which would go bankrupt. He didn't have any special insight into their competitive advantages or lack thereof. He couldn't, with any degree of confidence, project their future cash flows. And because he couldn't understand the businesses, he had no possible way of seeking disconfirming evidence. How can you find the flaws in a thesis you can't even formulate? How can you conduct a pre-mortem on a business model that is based on hope and jargon rather than on profits and moats? He famously said, "The most important thing to do if you find yourself in a hole is to stop digging." For Buffett, investing in an area where he had no expertise was like digging in a hole he couldn't see the bottom of. His refusal was not based on a prediction that the bubble would burst. It was based on intellectual humility. It was the ultimate application of the principles we've discussed. He knew that outside his circle of competence, he would be susceptible to every psychological bias. He would be unable to distinguish a good story from a good business. He would be a gambler, not an investor, so he said no. And then, in March of 2000, the bubble burst. The Nasdaq collapsed by nearly 80%. Hundreds of dot-com companies went to zero, wiping out trillions of dollars of speculative wealth. The investors who had mocked Buffett were financially and psychologically shattered. And Berkshire Hathaway, with its massive pile of cash, was there to pick up the pieces, buying wonderful businesses at bargain prices. Buffett's performance in the dot-com bust was the ultimate validation of the circle of competence. It proved that the most profitable decision an investor can often make is the decision to do nothing. It is the final and most powerful form of risk management, defining the boundaries of your own knowledge and never, ever straying beyond them. The underlying psychological principle that makes the circle of competence so essential is our profound and systematic overconfidence. Study after study in behavioral science has shown that we are terrible at assessing the limits of our own knowledge. This is often referred to as the illusion of knowledge. The more we are exposed to a topic through headlines and casual conversation, the more we feel we understand it, even if our actual, deep knowledge is zero. The dot-com bubble was a perfect storm for this bias. People heard the jargon, eyeballs, burn rate, first-mover advantage, and they mistook familiarity with the terms for a genuine understanding of the business dynamics. They felt like they were experts because the topic was everywhere. This is compounded by our deep-seated fear of missing out, or FOMO. When we see others getting rich in an area we don't understand, it creates immense psychological pain. It feels like we are being left behind. This emotional pressure can easily override our rational judgment, tempting us to make a bet, to take a flyer, on something we know we don't understand. The circle of competence is a conscious, disciplined defense against these two powerful psychological forces. It is an act of pre-commitment. You are drawing a line in the sand before the emotional storm of a market mania arrives. You are defining, in a calm and rational state, the specific areas where you have a genuine edge, a deep and demonstrable knowledge. This might be an industry you've worked in for 20 years, a hobby you've pursued with passion for a decade, or a business model you've studied intensely. The size of the circle is not important. As Buffett says, what's important is not how big the circle is. What's important is how well you define the perimeter. By defining this perimeter, you are creating a simple, binary rule for your decision-making. When a new investment idea appears, the first question is not, "Is this a good idea?" The first question is this inside my circle? If the answer is no, the analysis stops. It doesn't matter how compelling the story is, or how much money other people are making. The answer is no. This simple rule protects you from your own overconfidence and your fear of missing out. It acts as a filter that eliminates 99% of the speculative noise in the market. allowing you to focus your limited time and energy on the few opportunities where you can develop a genuine, evidence-based conviction. So how do you construct and maintain your own circle of competence? This is the applied blueprint for defining your intellectual territory. It is a process of self-assessment and continuous learning. Step 1. The knowledge inventory. You must conduct an honest and detailed audit of your own expertise. Take out a piece of paper and divide it into 3 columns. In the first column, Professional Edge, list the industries, business models, and processes that you understand deeply because of your career. If you're a software engineer, you likely have a deep understanding of enterprise software sales cycles. If you're a doctor, you understand the healthcare system and pharmaceutical trials. This is your most fertile ground. In the second column, Personal Edge, list the areas where you have deep, practical knowledge from your hobbies and passions. Are you an avid gamer who understands the video game industry? Are you a car enthusiast who understands the automotive supply chain? This is often an overlooked source of a genuine informational advantage. In the third column, Learned Edge, list the topics you have deliberately studied with rigor and depth over a long period. Perhaps you've spent years reading everything you can about the banking or insurance industries. Be brutally honest, a casual interest is not an edge. Only deep, sustained study qualifies. Step 2. Draw the perimeter. Look at your inventory. The items on this list constitute the current inside of your circle. Everything else in the entire universe of business and finance is, for now, on the outside. You must make a conscious commitment to yourself that you will not invest in anything outside this circle. This is your primary rule of engagement with the market. Step 3. The deep dive. Within your circle, you must commit to being a true expert. Your goal is to know more about the few companies you choose to invest in than almost anyone else on Wall Street. This means applying the principles from our previous pillars with ferocious intensity. You must read every filing, listen to every call, study every competitor, and build the most robust bull and bear case possible. Inside your circle, you are a specialist, a professional. Step 4. The cautious expansion. Your circle is not static. It can be expanded over time, but this must be done deliberately and patiently. If you want to add a new industry to your circle, you must commit to a structured learning program. This might mean spending 6 months reading the top 10 books on that industry, reading the last 5 years of annual reports for the top 5 companies in the space, and following the industry news daily. You earn the right to expand your circle through disciplined work, not through wishful thinking. This blueprint transforms you from a dilettante who has a shallow opinion on everything into a master who has a deep, defensible expertise in a few things. This is the foundation of a successful investment strategy and a secure financial life. The antithesis of this disciplined approach is what can be called the circle of confusion. This is where the 99% of investors live. They do not have a defined circle of competence. Instead, they operate in a permanent state of intellectual fog, chasing whatever is hot and making decisions based on fragments of information and borrowed conviction. The investor in the circle of confusion believes they can have a valid opinion on everything. One week they are an expert on biotechnology, the next on cryptocurrency, and the week after that on Chinese electric vehicle manufacturers. Their expertise is derived from a handful of articles, a few YouTube videos, and the general sentiment of the crowd. They are a jack of all trades and a master of none. Because they have no defined perimeter, they have no filter. They are susceptible to every fad, every story, every speculative mania that comes along. Their portfolio is not the result of a disciplined process. It is a random collection of lottery tickets, a museum of recent market bubbles. When one of these bets goes wrong, as it inevitably does, they have no foundation of knowledge to fall back on. They don't know if the setback is a temporary problem or a fatal blow to the business because they never understood the business in the first place. This leads to emotional decision-making, panicking, and selling at the worst possible time. The circle of confusion is a recipe for constant anxiety and poor returns. It is the result of intellectual arrogance, the refusal to admit "I don't know," which are the three most important words in the investor's vocabulary. It is the polar opposite of the CEO mindset, which is defined by a deep understanding of one's own limits. The direct financial connection between defining your circle of competence and achieving superior investment returns is profound. The primary financial benefit is the dramatic improvement in the quality of your decision-making. By only playing games where you have a demonstrable edge, you significantly increase your odds of success. Investing is not about being right all the time. It is about being right more often than you are wrong, and ensuring your winners are bigger than your losers. Confining your activities to your circle of competence is the most effective way to tilt these odds in your favor. This leads directly to higher long-term capital gains and faster portfolio growth. Secondly, this discipline has a huge impact on your risk management. The biggest risks in investing are not the ones you are aware of and monitoring. They are the ones you don't even know exist. When you invest outside your circle, you are operating in a field of unknown unknowns. You are vulnerable to being blindsided by a competitive threat or a technological shift that an expert would have seen coming from miles away. Staying within your circle minimizes these blind spots. It allows you to underwrite risk intelligently, which is the cornerstone of any professional wealth management strategy. Finally, operating within a circle of competence is the only path to developing true, high-conviction investment ideas. The kind of ideas you can confidently allocate a significant portion of your capital to. You can never have high conviction in an idea you don't truly understand. The investor who dabbles in everything will have a portfolio of 50 stocks, with none of them representing a position of any real consequence. They are diversifying their ignorance. The investor who operates within their circle might only own 10 or 15 stocks, but they will understand each of them at a granular level. This allows for a more concentrated, rational asset allocation that can produce market-beating returns over the long term. Your circle of competence is the ultimate financial filter. It protects your capital from your own worst impulses, focuses your energy on your highest probability opportunities, and is the final essential key to transforming yourself from a market speculator into an intelligent and successful long-term investor, capable of achieving true financial independence. You have made it through an intense and demanding intellectual journey. For the last hour, you have invested your most valuable asset, your attention, in a process of deconstruction and rebuilding. You have acquired a powerful mental tool, a new lens through which to see the world of investing and decision-making. You now understand that the goal is not to prove yourself right, but to rigorously and systematically try to prove yourself wrong. You possess the blueprint for inverting problems, for dissecting your own biases, for conducting pre-mortems on your best ideas, for building an information diet that feeds objectivity, and for defining the sacred ground of your own competence. This is more than a strategy, it is a complete operating system for rational thought. But this is not the end of the journey. What you have just mastered is a single crucial pillar in a much larger architecture. The mental models used by the world's greatest thinkers are not isolated tools. They are an interconnected network, a latticework of principles that support and reinforce one another. The principle of seeking disconfirming evidence is the foundation, but it is connected to other models that govern valuation, temperament, and long-term strategy. Mastering one gives you power. Mastering the system gives you a permanent, unassailable edge. The video that YouTube is recommending to you right now, the one you see on your screen, is not an accident. It has been selected because it contains the next piece of this map. It is the link that connects what you have just learned to the next level of understanding. It might be the model that helps you determine what a business is actually worth, or the one that allows you to control your emotions in a crashing market. It is the missing link. The choice you face now is not simply whether to watch another video. It is a choice about your own identity. Are you a passive consumer of financial entertainment, or are you an active builder of your own mental arsenal? The click you are about to make is a commitment. It is a declaration that you are serious about this path, that you are dedicated to the process of becoming a truly independent and rational thinker. The information is here. The next step is waiting. The only question is whether you have the discipline and the ambition to take it. Complete the map. Continue your ascent. Click the video.